And if more inflation comes through, Christine and I were discussing this yesterday, how much of an impact would it have on the earnings cycle, which has really been the bedrock for the markets over the course of the last 4 quarters? Does that get challenged? And so how much does the market get re-rated, account for that to the downside?
Well, one of the scenarios we're thinking about here is exactly what you're talking about there. Rates going up, that puts a dampener on growth, but at the same time, they're stuck because inflation is still elevated. And that's not great for risk. And I think the other thing is that the inflation has become, as we know, very politicized now, talking about income inequality, particularly inside the Fed. So they're really going to be gunning to get that inflation rate down. And maybe monetarist approach isn't the right tool here. If it's slowing growth and you've got that stagflation type environment, maybe the monetarist approach isn't the right tool here. So we'll have to wait and see. But at the moment, it looks like it's going to be a very tricky market. So we're advising investors, and the way we're investing is to be very, very agile here. Get your risk closer to home here, particularly in investment-grade credit markets. Potentially there's some interesting opportunities in high-yield markets still. But those that are more sensitive to interest rates, particularly investment-grade around the world, that's where we've been reducing risk. And as we get that 10-year yield up to close to 2%, we always seem to have a wobble in markets. So that's still another key break point, somewhere up around 225. Is that going to break the market again, particularly on the equity side?
Okay, Hayden, hi. This is Christine. Good to see you. Specifically, which Asian fixed income do you invest in? Where do you see the value?
Well, we've got completely the opposite situation in China today. So we've actually got rate cuts coming through. And we think they actually underdid the rate cuts here. So we're expecting more rate cuts to come through over the first half of this year. So we'd be long interest rate sensitive product in China today. And we think that's a great place where you're going to get some capital appreciation. You've also still got really low inflation there. So it actually hasn't been passed through to consumers. So you're seeing margin compression happening in China. It's coming through the producer price index, but it's not showing up in the CPI index. So even the real yields onshore in China offer you a lot of value as well. Plus, if you wanted to take the currency unhedged, as we saw last year, the renminbi outperformed the US dollar because the trade surplus has been so buoyant, and also the current account surplus continues to rise with inflows going in. So the currency, even on its own, looks pretty buoyant relative to other currencies around the world as well.